Hello students, welcome to my live teaching learning session of BECC 133 Principles of Macroeconomics. Today is the session in which we will discuss about quantity theory of money and monetary policy. As you know that we have started unit of money or money in a modern economy. In last session, we have discussed what is money, what is the main functions of money, and who supplies money in our country. So we have discussed about all these things like functions of money, meaning of money supply, components of money supply, and who supplies money in India. You know that RBI is the apex institution of monetary authority, and RBI supplies money. But 1 rupee note is issued by Ministry of Finance, Government of India. All the paper currencies, coins, notes, etc. are issued by Reserve Bank of India or Central Bank. Money has so many topics like money demand, money supply, quantity theory of money, monetary policy, credit creation, liquidity preference. So many topics are included in unit of money. So, in today's session, we will cover this quantity theory of money and some part of monetary policy. So, let us start from first topic quantity theory of money. This theory is known as Fisher's transaction approach. This quantity theory of money is very popular and very important thing. You must have to understand about how money supply affects the price level and what is the relationship between money supply or quantity of money and price level. As well as money supply increases, price level also increases. When money supply falls, price also falls. It means both have positive relationship or direct relationship or proportionate relationship between each other. Due to increase in money supply, price level will also rise. Due to fall in money supply, price level will fall. It is said by Irving Fisher. So it is known as Fisher's quantity theory of money because Irving Fisher propounded or popularized this theory. So this theory is known as Fisher's transaction approach. Now, what is the main thing of this quantity theory of money? What are the assumptions to formulate this theory? And why this theory was criticized by Cambridge University's economists? And what is the new approach of Cambridge University's economics or cash balance approach? In today's session, we will cover all these things. So let us start from first topic, quantity theory of money. This is the most influential theory of money. Firstly, it was proposed by David Hume in two articles of the Political Discourses of Money and of Interest. One article is Political Discourses of Money, and the second article is Political Discourses of Interest. So these two articles was proposed by David Hume. And this theory was also firstly propounded by David Hume. Modern interpretation was given by Milton Friedman as a stable money demand function. But this quantitative easing was an application of the quantity theory of money. And this theory was opposed by Adam Smith. You know that Adam Smith is father of economics, who gave the first definition of economics in 1776 as a wealth of nation. He said that economics is a science which deals with money or the functions of money. It means what is money, how we can earn money, how we can spend money, how we can generate money, all these things which are related with money. This is known as economics, in which we study about all functions and meaning of money, multiple creation of money or money multiplier, everything. So, quantity theory of money was opposed by Adam Smith and John Maynard Keynes. John Maynard Keynes is known as father of macroeconomics because G.M. Keynes introduced macroeconomics at that time when economy or whole world was suffering from depression period. And the famous book name of G.M. Keynes is the General Theory of Employment, Interest and Money, which was published in 1936. And he introduced macroeconomics at the time of depression during 1929 to 33. This time period was known as depression period. And quantity theory of money was first introduced by David Hume, but it was developed and popularized by Irving Fisher. That's why this theory is known as Fisher's quantity theory of money. But after propounded this theory and developed this theory, some economists criticized this theory, in which G.M. Keynes and Adam Smith opposed this theory of Fisher's quantity theory of money for different reasons. Now, what is the meaning of this quantity theory of money? This quantity theory of money is known as transaction approach of quantity theory of money. Irving Fisher. According to Irving Fisher, one of the normal effect of an increase in the quantity of money is an exactly proportional increase in the general price level or general level of prices. It means there is a positive, there is a proportionate, and there is a direct relationship between money supply and price level. Or in other words, we can say that whenever quantity of money increases, price level will also increase. When money supply falls, price falls. As well as RBI is issuing more paper currency, price level is going to increase. When inflation, when money supply was less, then price level was also very less. As well as money supply rises, price rises, but the value of money falls. Price and value of money has negative relationship. When money supply increases, price also increases. But the value of money means purchasing power of money. As well as price goes up, money value falls. Due to inflation, today the value of money is very less. As well as price increases, value of money go down. So, Irving Fisher theory mainly states three main important things. That one is that money supply or quantity of money and price level has positive, direct and proportionate relationship. This is the first theory of quantity theory of money, in which this is the first assumption or this is the first statement given by Irving Fisher, that there is a positive relationship between money supply and price level. Second thing is, money supply and the value of money has negative relationship. When money supply increases or quantity of money increases, value of money falls. As well as money supply rises, value of money falls. So there is a negative relationship or indirect relationship between money supply and value of money. This is the second main theory statement of this theory. Next is price level and value of money. Both have also negative relationship. When price increases, money value falls or purchasing power of the currency falls. And it is very common. You can see everywhere. Whenever price rises, you are holding money with whatever amount of money you have hold, the value of that money goes down. Purchasing power goes down. When price level rises, value of money falls. When price level falls, value of money or purchasing power rises. So there is an inverse relationship between price level and value of money. So three main conclusion, not only two, we can conclude three main conclusion we can draw with the help of this quantity theory of money, which is popularized or developed by Irving Fisher. One is, there is a direct proportionate relationship between the quantity of money and the general price level. Second is, there is an inverse proportionate relationship between the quantity of money. Quantity of money is also known as money supply. So we can write quantity of money, or in place of quantity of money you can write money supply. So money supply and the value of money has inverse or negative relationship. And price level, third main conclusion is price level and value of money has also negative or inverse relationship. So this is the main theory which is propounded by David Hume but popularized or developed by Irving Fisher, which is known as transaction approach of quantity theory of money. This theory is based on some assumptions. And what are these assumptions? These assumptions are, number one is, demand for money remains constant. Fisher assumed that demand for money should remain constant. It means only money supply will affect the price level, not money demand. There is no role of money demand in this context under this theory. So demand for money should remain constant. Next assumption is trade and business activities should also remain constant. Under this theory, Fisher assumed that trade and business activities like no business cycles will occur, no boom situation, no depression, no recession, changes will occur in economy. All economic activities and business activities or trade activities remains constant, then this theory will be applicable. Third assumption is, but this is not possible. This assumption is unrealistic, not accurate, because at present we know that economy is dynamic. Nothing is static in this world. Each and everything is going to change. So how we can assume that trade and business activities will not change in future? Will always remains constant? How it is possible when we are living in a dynamic world, not in a static world? Then how it is possible? But Fisher assumed that his theory will be applicable when trade and business activities will remain constant. when demand for money remains constant. But you know that demand for money also will not possible to remains constant, because as well as population increases, people's requirement or people need increases, the demand for money will also increase. Demand for money, which is demanded by people of the country, can never be remains constant. So this assumption is also unrealistic. But Fisher assumed to prove his theory accurate. So he assumed all that those things which can affect its theory. He assumed that these things remains constant. Third is supply of credit money should also remains constant. Supply of credit money means credit creation, which is the main function of commercial bank, should also remains constant, according to Irving Fisher. But you know that commercial bank's main function is to create multiple credit, to create more money with the help of existing money. So supply of money can never remains constant, but this theory assumed that supply of credit money remains constant. Next assumption is velocity of money should not change. What is the meaning of here velocity? Velocity means speed of money or circulation of money. We know that money can't remain stable only in a single hand. Money shift from one person to another person to someone other person. So money can be circulated in a day at 20 times, at 50 times, at 100 times. So many times money can be circulated or money can be transferred from one person to another person. So velocity of money tells us the speed of money. And how we can assume that speed of money remains constant? Velocity of money should not change according to this theory, but in reality, velocity or circulation of money can never remains constant, can never remains fixed. It can easily change day by day. It can change. So these are the assumptions, and some other assumptions are also uh, we can explain in this quantity theory of money, which is propounded by Irving Fisher. Like Fisher assumed that T remains constant, T is transaction. Transaction can never remains constant, but Fisher assumed that transaction, demand for money for transaction purpose should remains constant. And there is a full employment exists in the economy, according to Irving Fisher. Irving Fisher theory is applicable in long run, not in short run. Fisher assumed that in long run, full employment we can always achieve. And it's very easy to achieve full employment level in long run. So in long run, when full employment is achieved, then whenever money supply rises, only price level will rise and value of money will fall. This is the main idea of this quantity theory of money according to Irving Fisher. Now next is quantity theory of money we can explain with the help of this equation. Here is the equation of quantity theory of money, that is MV is equals to PT. M is money supply, V refers to velocity of money or change in money. Velocity means circulation of money. And P is price level or general price level in the economy. And T means transaction. People always demand for money for specifically transaction purpose. because we need money for day to day transactions. Some goods are perishable in nature. We can't store that commodities. For example, bread, butter, milk, fruits, vegetables, and for transportation or other expenses, we need money. So we need money for transaction purpose, which is the main first purpose of demanded money or demand for money. We shall assume that T transaction demand for money remains constant. Here MV is showing money supply and PT is showing money demand. And we should assume that money supply is always equals to money demand. There is no difference in money supply and money demand. Whatever money is supplied by Reserve Bank of India, that is demanded by country people. There is no increase or decrease in money supply or increase in money demand. No disequilibrium situation occur according to Irving Fisher. So MV is equals to PT. Here M is money supply, V is velocity of money or circulation of money, P is price level or general price level of the economy, and T is total index of physical volume of transactions. And if we want to show the positive relationship between M and V, we must have to assume T and V should remain constant. If we want to calculate the direct relationship between MV and PT, then we will assume that price is a passive factor. If price is a passive factor, then price will affected by money supply change, but price can never influence to money supply. Irving Fisher assumed that price is a passive factor, not an active factor. It means price cannot affect any variable or any other thing, but price can be influenced by money supply. So money supply and price both have direct relationship, both have positive relationship when velocity of money and transaction demand for money remains constant. Then there will be direct relationship between M and MV, M and P. If V remains constant, T remains constant. Now next is, and if we want to calculate P, then MV upon T, in which we assume that V and T will remain constant and money supply will directly affect to the price level because P is a passive factor according to Irving Fisher. Now next is, this is the positive and direct relationship between money supply and the price level. First figure is showing that here is the direct relationship between money supply and price level. When money supply is less, price will be less. As well as money supply increases, price level will also increase. If money supply increases from M1 to M2, then price level will also increase from P1 to P2. So there is a positive, there is a direct, and there is a proportionate relationship between money supply and price level. So this is the first main point of this quantity theory of money, that there is a direct and positive relationship between money supply and price level, and the curve will be 45-degree line upward sloping curve. Next is, you know that money supply and value of money has negative relationship. Price and value of money has negative relationship. So if there is a negative relationship between value of money and money supply, then diagram will be downward sloping from left to right. It will show the negative relationship between quantity of money and value of money. We will take quantity of money on x-axis and value of money on y-axis. When quantity of money is m or less, then value of money is very higher. At the time of independence, the value of money was very higher and the quantity of money was very lower. But at present, if we see that, then money supply is very higher and the value of money is very lower. So as well as money supply increases from M to M1 and M1 to M2, value of money falls from V to V1 and V1 to V2. So there is a indirect or inverse or negative relationship between velocity of money and value of money and quantity of money. Same as we can draw negative sloped curve in case of value of money and price level, because price level and value of money has also negative or inverse relationship. So curve will be downward sloping. So this is the main two curves of this Fisher's quantity theory of money. One is positive, which is the main theme of this theory, that there is a positive and direct relationship between money supply and the price level, and curve will be 45-degree line which shows proportionate increase or proportionate relationship between price and quantity of money. Now next is, in this equation here, Fisher include some other variables in his equation. His simple equation was mv is equals to pt, in which we can calculate p is equals to mv upon t. But due to some criticism or due to some thoughts which he took from other economics, that other economics said that Fisher should include change in money supply and change in velocity of money in his equation. That's why Fisher included m dash and v dash in his previous equation, which was only mv is equals to pt. So this is the modified equation of Irving Fisher's quantity theory of money. This modified equation include m dash and v dash according to some other economics suggestions. They said that money supply can change. So how we can say that money supply is constant? So if there is any change in money supply, you should also include in your equation. That's why Fisher include this change in money supply and denoted by m dash. And velocity of money or circulated money can also be changed. It will not remain always constant. So it should also include in Fisher's quantity theory of money equation. That's why Fisher agreed and Fisher included this v dash also in his equation. So the now new equation or modified equation is mv plus m dash v dash is equals to pt. And if we want to calculate p, then equation will be mv plus m dash v dash divided by t. For example, if we have given the value of m is 1000 and the velocity of money value is 3, then 1000 into 3 plus m dash is 500 and v dash is 2, then 500 into 2 divided by transaction, which is 4000. If it is all values are given, then you can put in this equation and find out the price level. So here 1000 into 3 is 3000 plus 500 into 2 is 1000. 3000 plus 1000 is equals to 4000, and if 4000 is divided by 4000, then value will be 1 rupee. So price is rupee 1 per good. So value of money, if we want to calculate, 1 upon p, its formula is 1 upon p. 1 upon p means 1 upon 1 is equals to 1. And if the supply of money is doubled, For example, instead of 1000, this money supply double from 1000 to 2000. Then we can take, instead of 1000, we will take 2000 into 3 plus 500 instead of this. It will also double 1000 into 2 upon transaction demand for money remains constant. Then what will be the value of price? 2000 into 3, 6000 plus 1000 into 2, 2000. So 6000 plus 2000 is equals to 8000 divided by 4000. The value will be 2. So here price will also increase by 2 per good. Here we can say that there is a positive and direct relationship between money supply and price level. It is clear from this example. When money supply was 1000, then price was 1 rupee per good. When money supply doubles, then price also doubles from 1 rupee to 2. And money supply double 1000 to 2000. It means there is a positive and direct relationship between money supply and price level. And money supply and value of money has negative relationship. Value of money, how you can calculate? 1 upon P. First time when price is 1, then value of money was also 1. But if price is 2, then the value of money will be half 1 upon 2. So if money supply increases, price increases, value of money will fall. So this is the main conclusion of this theory, Fisher's quantity theory of money. Now next is cash balance approach. This cash balance approach was the another theory of money demand. According to Irving Fisher, Fisher gave more emphasized, more stress on which concept? Money supply. Again he said, again and again he said that whenever money supply rises, price levels rises and value of money falls. When money supply falls, price level will also fall and value of money will increase. According to Professor Tozing, when money supply double, then price level will also double and the value of money will be half, and vice versa. If money supply is half, then price level will be half and value of money will be double. This is the main concept of quantity theory of money. And it give more emphasis on which concept? Money supply or money demand? It mainly emphasized money supply. But the another approach is cash balance approach. This approach was propounded by Cambridge University's economist, in which Marshall, Pigou, Robertson, and J.M. Keynes name is very popular. They all are Cambridge University's economists and great economists. They propounded different theories and they gave more contribution in economics. So, cash balance approach, which is propounded by Cambridge University's economics, in which Marshall, Pigou, Robertson, and Keynes name is very famous, and this is a theory of money demand. Pigou, who gave welfare theory, Marshall explained theory of demand, and Marshall has great contribution in microeconomics. Robertson said that resources are limited, wants are unlimited. We should use alternative, all the available resources so that we can fulfill our unlimited want with the help of limited resources. And J.M. Keynes is the father of macroeconomics. So Pigou argues that agents choose to allocate resources to a portfolio of assets, which is based upon convenience and security. The issue is the proportion allocated to money, and K is equals to KR. R is rate of interest and K is the proportion of money which we use to allocate for transaction. R refers to attractiveness of rival uses of resources. When R increases, K falls. When R falls, K increases. So there is a discussion regarding the provision of security against unexpected demand due to sudden need or rise in price level. So K is the proportion of money income which everyone want to keep in cash form for transaction purpose, for precautionary purpose, and for speculative purpose. Because according to Keynes, money is demanded by each and every country people for specifically three purposes, in which first purpose is transaction purpose, second is precautionary purpose, and third purpose is speculative purpose, in which we can increase multiple money with the help of existing money. So this cash balance approach mainly emphasize money demand, not money supply. And the main economists who propounded this cash balance approach, the name of these economists are Marshall, Pigou, Robertson, and J.M. Keynes. And all are Cambridge University's economists. Now next is money demand and the quantity theory of money. When we talk about money demand and quantity theory, so this approach is called cash balance approach, because quantity theory of money, if it is related with money demand, then it will be said that it is a cash balance approach. And if quantity theory of money is related with money supply, then it will be said that it is related with Fisher's quantity theory of money. Because Fisher explained this quantity theory of money with the help of the relationship between money supply and price level. But cash balance approach or Cambridge University's economics approach is based on money demand. So Cambridge approach said that M is equals to KPY, where K is the fraction of income or spending that people have command over in the form of money balances. And K is equals to 1 upon V. Both the equation of exchange and the cash balance approach are identical. P is the price level, Y is income, and K is the proportion or the fraction of spending that people have command over in the form of money balances. So manipulation of the equation of exchange results in the Cambridge cash balance approach or the demand for money equation. Now next is Cambridge equation of cash balance approach. You know that Cambridge University's economics names are Marshall, Pigou, Robertson, and J.M. Keynes. And all Cambridge University's economics propounded this cash balance approach or quantity theory of money by demand for money approach or money demand approach. And all economists gave different equations according to this cash balance approach. Like Marshall propounded equation for cash balance approach, which is M is equals to KPY. Here K is the fraction of money which people want to keep in cash form, P is the price level, and Y is the income level of the country. Equation of Pigou is P is equals to KR divided by M. P is the price level, K is the fraction of money income, and R is the responsiveness of money demand according to the change in the need of the people and M is money supply. Equation of Robertson is P is equals to M upon KT. M is money supply, P is price level, K is the fraction, T is transaction. And equation of Keynes is equals to N is equals to PK. N is money supply, N is money's demand is equals to PK. P is price and K is the fraction of income which everyone wants to keep in cash form. So these are the different equations of cash balance approach propounded by different Cambridge universities economists like Marshall, Pigou, Robertson, and Keynes. Next is basis of difference. What is the difference between Fisher's quantity theory of money equation and Cambridge University equation? What is the difference in between of these two equations? Now, Fisher's equation, which is mv is equals to pt, it's a very simple equation, but after some including modification or changes, this equation is mv plus m dash v dash is equals to pt. Fisher's equation gives importance to flow of money because it is related with money supply. And money supply, if we are taking that m dash is change in money supply and v dash indicate change in velocity of money. So Fisher's equation gave importance to flow of money, and Cambridge equation gives main importance to on stock of money, not flow of money. It gives main importance to stock of money. Next is price level. According to Fisher's equation, P represent the average price or general price of all goods and services. And according to Cambridge University's equation, P represent the price of only consumer goods, not all commodities price represented by P according to Cambridge equation. Cambridge equation, under this P represent the price of only consumer goods, but in Fisher's equation P represent the average price level of all goods and services. Now next difference point is stress on demand and supply. Who gave main stress on money demand and who gave main stress on money supply? Fisher's equation gave more stress on money supply, and Cambridge University's equation gave more stress on money demand. So Fisher's viewpoint, stress on money supply or supply of money, and Cambridge University's or Cambridge viewpoint, stresses on demand for money. Next is time. Fisher's equation is associated with period of time because it's a flow concept. It takes the equation which is related with the flow of money, so it is associated with period of time. And Cambridge equation, which mainly stresses on stock of money, so it is associated with point of time because stock concept is related with point of time and flow concept is related with period of time. For example, national income is a flow concept because if anything which is related with per day, per month, per week, per hour, or per year, that concept is called flow concept. National income is estimated yearly basis and every year estimated by NSSO, national income. So it is associated with period of time because it's a flow concept. But national wealth, national capital is a stock concept because it is related with point of time or specific time point. So stock concept is related with or associated with point of time. Now next is demand for money. According to Fisher, the demand for money is actually for only transaction purpose. Fisher said that money is demanded for by country people for only transaction purpose, not for any other purpose. But according to Cambridge University's economists, their main ideology, which is based on that demand for money is for storage of money. And it means people can demand for money for storage, for precautionary purpose, and for speculative purpose, not only for transaction purpose. So, according to Cambridge ideology, demand for money is for storage of money, and according to Fisher, the demand for money is only for transaction purpose. So this is the main difference in between of Fisher's equation and Cambridge University's equation given by Marshall, Vigo, Robertson and Keynes. Now next is criticism of this theory. You know that Irving Fisher's quantity theory of money, which was propounded or developed by Irving Fisher, that assumed some that is the that based on some unrealistic assumptions, based on some those assumptions who are not operational or practically, if we see that they are not actual exist at present, because Fisher assumed that P is a passive factor, but we know that under law of demand, law of supply, price is not a passive factor. Price mainly affects demand. Price mainly affects supply. Price is a passive. Price is an active factor, not passive factor. Price can also affect the demand of the commodity and the supply of the commodity also. So, number one criticism is truism. According to Keynes, the quantity theory of money is a truism. Fisher's equation of exchange is a simple truism because it states that quantity of money or total quantity of money, which is mv plus m dash v dash, paid for goods and services, must equals to their value pt. But it cannot be accepted today that a certain percentage change in the quantity of money leads to the same percentage change in the price level. According to Fisher, there is a positive, proportionate, and direct relationship between money supply and the general price level, but it cannot be accepted today because it is not always possible that money supply, if doubles, then price level will also double. If money supply will halve, then price level will also halve. It is not true or not accurate. It is not accepted by Cambridge University's economics. And practically, if you see that, it's not true always. So, according to Keynes, the quantity theory of money is a truism. Fisher's equation of exchange is a simple truism because it states that total quantity of money, which is presented by mv plus m dash v dash, is equals to or paid for goods and services must equals to pt. P is price level or general price level. T is transaction purpose because Fisher assumed that money is demanded by country people only for transaction purpose, not for any other purposes. So it cannot be accepted today that a certain percentage change in the quantity of money leads to the same percentage change in the price level. Now next is credit creation process. that commercial banks can create, and some other assumptions we can also criticize. That Fisher assumed that P is a passive factor. At present P is not a passive factor, it's an active factor, and P play very important role to affect demand and supply of the commodity. And Fisher assumed that there is a long run time period and full employment always exists. But that full employment is not a very simple or very easy phenomena which we can achieve very easily. Full employment cannot be exist either in a developed country or in a developing country. Full employment is a very rare situation. Fisher assumed that full employment always exists. That's why he assumed that there is a positive or direct relationship between money supply and price level. Next is Fisher theory is based on unrealistic assumptions. Like Fisher assumed that transaction remains constant and demand for money remains constant and price is a passive factor, and Fisher multiply M into V. M is related with money supply, which is a stock concept, and V is related with velocity of money or circulation of money, which is a flow concept. And if we multiply stock concept into flow concept, then the result will be inconsistent or mathematically wrong. So, Irving-Fisher equation and Irving-Fisher assumptions was based on some unrealistic uh, thoughts, unrealistic things. That's why all the assumptions which assumed by Irving Fisher to give explanation of his theory was criticized by Cambridge University's economists, and so we can say that G.M. Keynes' theory is much superior than Fisher's quantity theory of money, but we can't forget the importance of Fisher's quantity theory of money, because if Fisher was not propounded that theory, then how we can get new or modern theories? So Fisher's theory play very important role in this money supply, money concept, and money unit. And this theory was not fully inaccurate or unrealistic. It's true because Fisher assumed that full employment, at the level of full employment, we can't increase income, we can't increase output, we can't increase employment level. We, if demand increases, then only price will rise, nothing will increase. So Fisher's theory, at their own ground, it's very accurate, it's very true, because if we achieve full employment, then output, employment, and income will not change, only price will change. So if full employment exists in the economy, then whatever increase in money supply will directly or proportionately affect the price level. Money supply rise, price level will also rise. Money supply falls, then price level will also falls, and by the same ratio or proportionately. But according to Keynes, full employment is a rare situation. Full employment is a very rare, and it cannot be achieved very easily. When, first of all, when money supply increases in the beginning, rate of interest will fall. Rate of interest will fall whenever money supply rises by the Reserve Bank of India. Then what will happen? First of all, rate of interest will fall. When rate of interest will fall, then borrowing will be cheaper and borrowing cost will be cheaper. Investors will be interested to take more loans for taking more advances from commercial banks. In this case, investment will increase. At lower rate of interest, investment will increase. When investment will increase, then production will also increase. When production will increase, then employment level will also increase. income level will also increase, and all things will increase. And this process will go on continuously till the full employment, until the full employment achieved. If full employment achieved, then nothing will increase. Then income output and employment level will remain constant. Then what will increase? Only price level will increase. So according to Keynes, Fisher theory is not fully false. It is true, and but Fisher ignored this whole process of increase in price level. But Keynes included the whole process of this increase in price level due to increase in money supply, the whole steps which lie in between of this positive or direct or proportionate relationship, that was ignored by Irving Fisher but included by J.M. Keynes. That's why J.M. Keynes theory is more popular, is more superior than Irving Fisher's quantity theory of money. But the main reason is that Fisher ignored the whole process, but Keynes include the whole process which lie in between of the positive and direct relationship between money supply and the price level. So this is the main thing which which is showing the whole concept of quantitative theory of money. Now next is a credit creation process. Credit creation process we will cover in next session, and monetary policy we will also explain in detail in next session. But in a brief, I can give you a very simple idea that what is the meaning of this credit creation process, and what is the main thing of this concept. So this is the credit creation, but in detail we will explain in next session. Credit creation process is mainly the process of commercial bank through which commercial bank can create multiple money with the help of existing money. Savers always deposit their money in banks, and borrowers can take borrowings from banks. So savers are lenders, and savers are depositors who deposit their money in banks, and banks are lenders who lend their money to the borrowers, and the firms and business enterprises are borrowers who take money from banks for their business activities. Savers take interest receipts on their deposits, and borrowers pay interest payment to the bank. So in this process, bank can create multiple money. If bank has 1,000 rupees, bank can create 10,000 rupees with the help of this credit creation process. And the earning of banking system through this credit creation process, we will explain in detail in next session. But in brief, we can say that commercial bank's main function is to create more credit with the help of existing money or primary deposits. And money multiplier we can calculate by 1 upon required reserve ratio, or 1 upon CRR, cash reserve ratio. Monetary policy is also very important policy, because monetary policy, you know, that made by Reserve Bank of India to control the supply of money. If RBI wants to control the money supply, then some RBI can easily control this money supply with the help of monetary policy tools, and to regulate the supply of money, to control the credit creation process by some tools of monetary policy, like or instruments of monetary policy, like bank rate, open market operation, cash reserve ratio, statutory liquidity ratio, and margin requirement, moral social, direct action, and credit rationing of the credit. So these are some instruments or tools by which monetary policy can work smoothly and RBI can control and regulate the supply of money. And monetary policies, the main objective is to stable the price level, to stable the foreign exchange rate, to stability in financial level, and to growth in employment and income. So in this session we have discussed about Fisher's quantity theory of money and some concepts of credit creation and monetary policy. But the detail of monetary policy and credit creation we will cover in next session. Thank you.